Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing the winners and losers from DeepSeek and Trump's executive orders. The market had its first wobble in a while last week, and it had nothing to do with all the executive orders Donald Trump was signing, or even fourth quarter earnings season. This time, it was a tiny LLM model from China that got Silicon Valley and Wall Street wondering if investing $600 billion in GPUs was such a great idea after all. So this week, we're taking a closer look at the potential winners and losers from the DeepSeek R1 saga. Plus, we're also going to take a look at the potential winners and losers after Donald Trump's first 10 days in office. Before we cover what happened in markets this week though, here's our quote of the week from William Stanley Jevons. It is wholly a confusion of ideas to suppose that the economical use of fuel is equivalent to a diminished consumption. Whatever, therefore, conduces to increase the efficiency of coal and to diminish the cost of its use, directly tends to augment the value of the steam engine and to enlarge the field of its operations. He said that quote in 1865. Now, let's dive in. Here's a quick summary of what's been going on. Firstly, from S&P Global. Merger and acquisition activity in Europe shows signs of recovery in Q4 last year. What's our take on this news? European and UK banking stocks could see higher fee income from mergers and acquisitions. Deal-making in the region has been subdued for the last few years, but that could be changing. DealSweep, the merger and acquisition sourcing platform, said that trends like, quote, tech advancements, AI, automation, sustainability, and industry consolidation, end quote, will influence market dynamics in 2025. KPMG tends to agree and also believes that global M&A activity is picking up momentum. There are a few parties that would benefit from this trend. Firstly, acquisition targets getting bought out by better finance competitors. Secondly, those with the means to acquire desirable businesses that are trading on the cheap. And lastly, banks, those who are facilitating the deals and making fee income from it. Next up from S&P Global as well. Australia could feed rising tantalum demand. What's our take on this news? Rare earth mineral providers in safer jurisdictions could see some tailwinds from this. Tantalum, a common byproduct of lithium, is on the critical minerals list of several countries, including the US, the UK, India, and Australia. Funnily enough, Australia has the largest estimated reserves at 25.5% of global supply, but it ranks 6th in terms of production, behind the Democratic Republic of Congo, Rwanda, Brazil, Nigeria, and then China. Demand for the mineral is expected to continue growing slowly, since it's a key input in the electronics, aerospace, and medical sectors. However, supply chains in Africa explain why some Australian mines are well positioned to benefit. Stocks like Pilbara Minerals, Wildcat Resources, and a few other stocks that are microcaps have exposure to this resource being mined in Western Australia. Next up from Sherwood. Starbucks keeps struggling as it waits for its new CEO's plan to percolate. What's our take on this news? It takes time to change direction on a large boat, and Starbucks' situation is no different. Starbucks beat analysts' low expectations on its latest earnings report, despite earnings being 23% lower and same-store sales also lagging. Analysts want to see change in a few quarters rather than years. Quite a hard task, but investors are typically an impatient bunch. New CEO Brian Niccol joined in September and has this big task ahead of him. He's already started implementing plenty of changes to try and get stores back to their, quote, cozy coffeehouse vibes that enticed customers to visit in the first place. Time will tell if the company can pull it off, but given his track record and the current stock price, investors seem to think it can. Next up from Reuters. Wall Street regulator revokes accounting guidance on crypto assets. What's our take on this news? It's a win for the crypto and banking sector and yet another pivot away from the prior administration. The law in question, SAB 121, which stands for Staff Accounting Bulletin 121, forced banks that want to act as custodians over crypto assets for their clients to record them as liabilities on their balance sheet. This meant they'd need to acquire $1 of assets for every $1 of crypto assets they held in custody for clients. As you can probably imagine, this made it uneconomical for them to do so. Last year, both the House and Senate voted to rescind SAB 121, but former President Biden at the time vetoed the decision. Apparently, the banking industry has, quote, welcomed the withdrawal of the guidance. The change now restores banks' ability to serve as custodians for clients who want to own digital assets. With this news, we should expect to see banks start to offer custody services in this space. Next up from Business Insider. Bitcoin boosts Tesla profits by almost $600 million after accounting rule change. What's our take on this news? Expect plenty of earnings volatility, both up and down, from companies that hold crypto on their balance sheet. The FASB rule changes late last year now allow companies to mark their crypto holdings at market value. Previously, they were only allowed to mark it either down if it had declined or at cost if it was above cost. This $600 million boost to Tesla's GAAP earnings was 9% of its $7.1 billion profit in 2024. Remember, that $600 million isn't cash flow, it's only paper profits that would become cash flow if it's sold. Regardless, Tesla might be regretting selling 75% of their Bitcoin holdings back in 2022 for $1.7 billion at $20,000 per coin each. These FASB accounting rule changes remove a pretty large impediment to holding the likes of Bitcoin, so we may see more companies adopt a similar approach with their balance sheets. Now, let's dive in. First, we're going to start with Trump's Week 1 executive orders. As expected, Donald Trump was in the Oval Office signing a pile of executive orders within hours of his inauguration. Below, we've summarized key takeaways from those orders most relevant to investors. There's a sortable list of executive orders, including the actual wording, on the NPR website, and there's a link to that in the article. Let's start with trade. As of the 29th of January, President Trump hadn't announced any specific tariffs or trade policy action. However, the White House said he still planned to impose tariffs on Mexico and Canada, and possibly on China, on Saturday the 1st of February. He appeared to be using these threats as bargaining chips for those countries to act to stop illegal immigrants and fentanyl from entering the US. Trump also directed various agencies to investigate unfair trade policies, currency manipulation, and trade agreement violations by other countries. So what's the implications for investors? After all the rhetoric, it was a little surprising to see no action on day one, but some may be due soon. With so many economists warning that blanket tariff policies will be detrimental to the economy, it's possible that Trump may be backing off on the intensity of his initial plan. Alternatively, there may be ongoing negotiations behind the scenes. Markets are already pricing in some impact from tariffs, so a meaningful softening of trade policy could lead to a weaker dollar and lower rates, which would be good news for companies exporting from the US and foreign companies importing from the US. Next, let's talk about energy. Trump signed several executive orders aimed at increasing US oil and gas production. These include removing restrictions on oil and gas drilling, particularly in Alaska, offshore, and on 16 million acres of land protected by a Biden directive. Secondly, fast-tracking permits for LNG projects in Alaska. And thirdly, reviewing LNG export projects and permits, because issuing new export permits had been paused. What's the implication for investors here? These actions were largely anticipated. The fact that they were amongst the first orders to be signed reflected that energy production is a priority. But there is more to increasing oil and gas production than issuing more permits to drill. Refining, storage, and pipeline capacity must also be increased, all requiring capital. And for these changes, investors must look beyond the next 4 years. The chart above from JP Morgan shows how new pipeline capacity has fallen during the last decade. And here we see which part of the industry has seen the most gains since the election. Some analysts have also warned that OPEC Plus countries could retaliate by increasing production, causing prices to fall below the production costs of US producers. The diversified oil producers like ExxonMobil and Chevron are already focusing on high-margin assets, but would need to increase investments in order to ramp up production substantially. Smaller companies may have the opportunity to increase production significantly, but would also be very sensitive to lower oil prices. Make sure you check what the company's cost per barrel to produce is. Those with more buffer will see less impact on their margins if the oil price reduces. Next, let's talk about the environment and renewable energy. The Trump administration was also quick to withdraw from the Paris Agreement and roll back Biden's policies that favored renewable energy. These included, firstly, halting offshore wind leasing and onshore wind permitting. Secondly, prioritizing economic efficiency over environmental concerns. Thirdly, revoking a mandate for zero-emission vehicles. And fourth, disbanding the interagency working group on the social cost of greenhouse gases. What's the implication for investors here? These actions were also widely expected by the market and are bad news for the renewable energy industry. Most stock prices in these industries already reflected this sentiment. However, the administration is also likely to face legal and political challenges, particularly when it comes to projects that have already been approved. Many of the projects initiated under Biden's Inflation Reduction Act have resulted in new jobs, which would be lost if some projects are terminated. The wind industry is certainly in the crosshairs, while solar projects are less affected, though they probably can't expect any significant government support. Legacy automakers may begin to reconsider their EV plans. Next, let's talk about immigration. Trump's executive orders concerning immigration were wide-ranging. The orders aim to make legal and illegal immigration to the country more difficult. Deportations have already begun across the country. What's the implications for investors? These actions were also no surprise and are expected to cause far lower net migration. Regardless of the actual number of deportations, lower immigration rates are likely to affect the labor market for certain industries, particularly agriculture, hospitality, and manufacturing. The increased focus on border security should benefit certain sectors like defense contractors. Next, let's talk about crypto. The Strengthening American Leadership in Digital Financial Technology Executive Order lays out several initiatives to develop the digital asset industry. Key initiatives here include 1. Directing federal agencies to collaborate on developing a regulatory framework that promotes innovation while mitigating risks. Secondly, encouraging US leadership in shaping global digital asset standards. Third, establishing guidelines to safeguard consumers and investors from cybersecurity threats and fraudulent activities. Fourth, evaluating the potential creation of a digital asset stockpile. And fifth, prioritizing dollar-backed stablecoins over central bank digital currencies, known as CBDCs. What's the implication for investors in this? Developing a proper regulatory framework is a huge step for the industry. Unfortunately, it was also overshadowed by Trump issuing his own meme coin just 3 days before he took office, and, as expected, some are questioning his motives. The working group has 180 days to deliver their, so don't expect clarity in this area in a hurry. This delay could lead to uncertainty and volatility in the crypto market in the near term. And lastly, deregulation. Trump issued wide-ranging orders regarding regulation across several industries. This included rescinding 78 executive orders and memorandums signed by former President Biden, all regarding regulations. What's the implications for investors? Well, deregulation has always been a cornerstone of Trump's agenda, and these actions were in line with expectations. Removing the cost of remaining compliant is particularly helpful for smaller companies, think small caps. It's also a positive for the financial sector when more deals are approved and more financing is needed. Of course, deregulation can also lead to increased systemic risk, which typically only becomes apparent at a later date. So with all that being said, let's look at these executive orders versus reality. Executive orders do have certain limits. Typically, an executive order takes 6 to 12 months to implement, but some can take just a matter of days, as we've seen. They can also be challenged in court, causing even longer delays. In addition, certain orders are subject to funding that must be approved by Congress. That shouldn't be a problem, assuming Trump can manage to keep the GOP in line. All of this means that there could still be a level of uncertainty in the first year, which may very well lead to periods of volatility. For example, retaliation on trade tariffs, or the suggestion of retaliation, would probably lead to volatility too. Towards the end of the year, there should be more clarity on policy direction. Now, for the second topic this week, let's talk about whether DeepSeek actually upends the AI industry. A few weeks ago, few people had heard of DeepSeek, a Chinese AI startup. By last week though, most of the world, and every NVIDIA shareholder, was learning about DeepSeek and its open-sourced R1 model and Jevons paradox. Because plenty of other publications have covered the technical side of things, we aren't going to go into too much detail about the model itself. Instead, we're going to focus on the possible implications for investors. If you do want a more detailed overview, Ben Thompson wrote an excellent DeepSeek FAQ on his Stratechery blog. So, what's all the fuss about? While we're not going to get too technical, we do need to cover a few things about the model. DeepSeek's R1 model is noteworthy for more than one reason. Firstly, cheap and dated hardware. It was trained on H800 NVIDIA chips, which are both dated and intentionally inferior to the latest NVIDIA chips available outside of China. The final training run costs $5.6 million, which is a fraction of the cost incurred training the most advanced models developed by OpenAI, Anthropic, and other leading LLM developers. Secondly, new techniques. The model uses several innovative techniques to reduce memory use during training and inference. And lastly, outperformance. It's particularly adept at reasoning, where it outperformed every other model apart from OpenAI's O1. When it comes to more advanced reasoning, it beats every model, including O1. Interestingly, it was less competitive with mathematics questions and coding tasks. By the way, the LLM Stats site is a fascinating resource to compare LLM models across various benchmarks and tasks. You can also see how quickly all the models are advancing over time. So, is DeepSeek's R1 model really as good as claimed? There have been numerous criticisms about the process DeepSeek used to build and train its models. The company likely used OpenAI's models, and others probably, to train its own. So, Microsoft and OpenAI are probing into how they potentially obtained the data. That means the efficiency claim is somewhat misleading, as R1 benefited from all the GPUs and expenses that went into training those models rather than starting from scratch. Also, LLM models can be trained to score well on certain tests. For example, if you're a startup looking to make a big name for yourself, you'll optimize your model to perform well on the test. If you have bigger goals, you might pay less attention to those test results. Assuming R1 was trained using other models, which is still yet to be proven, it would have to be updated using other models to remain competitive. So it may not be as much of a leading edge model as the table above suggests. However, DeepSeek's R1 model does prove a few things. Firstly, the potential of distillation, where the capabilities of a large model can be transferred to a smaller, more efficient model to perform specific tasks. Secondly, China isn't as far behind in AI as some may have originally thought, and banning chip exports to China might not be very effective. And thirdly, open source LLMs are for real, and open source projects often attract talented engineers. There are also numerous security and privacy concerns about the app that's available for smartphones. Those concerns may well be warranted, but they are a separate issue from the underlying model. So let's talk about the implications for investors and for companies in the AI ecosystem. It didn't take long for DeepSeek to make it onto the Wikipedia page for Jevons paradox, and it's an excellent example of the paradox in action. Jevons paradox suggests that as a resource becomes more efficient to use, people find new uses for it, causing overall consumption to increase. This has occurred with coal, oil, steel, electricity, motor vehicles, and the internet. Returning to generative AI, more efficient models will reduce the cost of inference. This will make it cheaper to build and run applications, which may well speed up the adoption of those applications. A year ago, we wrote about the 6 layers in the AI value chain, and you can find a link to it in the article. This is relevant to the potential impact of more efficient models. Below are the 6 layers and examples of companies within each layer. Firstly, there's the hardware layer, with the likes of NVIDIA, Broadcom, and Supermicro. Then there's cloud providers like Microsoft, Alphabet, and Amazon. Also, electricity generation is adjacent to this layer. Then there's the LLM model developers like Alphabet, Meta, Anthropic, and DeepSeek. Then there's model hubs and machine learning ops like Databricks, Microsoft's Azure ML, and Hugging Face. Then there's applications from the likes of Meta, Alphabet, Salesforce, and AppLovin. And lastly, there's services from the likes of IBM, Kyndryl, HPE, and Accenture. In the near term, cheaper or more efficient inference could lead to more rapid development and adoption of applications built on top of LLMs. That would be good news for app developers and the companies that support them. For the infrastructure layers, layer 1 to 3, more efficient models could lead to a drop in demand for compute power and electrical power. Data centers might struggle to recoup their investment in GPUs and might decide to buy fewer of those GPUs. Ultimately, faster adoption should lead to more demand for compute power. If that's the case, it's really a matter of timing. Will AI adoption increase fast enough to generate demand for compute power at the rate it's currently being built, or will there be a lag with NVIDIA GPUs sitting idle in data centers? So, what's the insight here? Look at both sides of the story, then assess the probabilities. Generative AI is likely the most important secular trend of this era, and NVIDIA has understandably been the biggest winner so far. However, any company is likely to face challenges from time to time. The higher the market's expectations, the bigger the correction when cracks appear in the bull case. Diversifying across the AI value chain is one way to reduce risk. The other is to make sure you're aware of potential bearish scenarios. Simply Wall Street's collection of narratives written by community members is growing by the day. There are now 10 narratives for NVIDIA, presenting a wide range of potential outcomes. This narrative, published in 2023, highlighted the risk of oversupply as GPU performance accelerates. By reading narratives, you can make sure you're aware of potential catalysts you may have missed, particularly those that contradict your thesis. Even if you don't agree with the overall thesis, you can add them to your list of potential risks to keep an eye on. Speaking of AI, Simply Wall Street's Warren AI generates narratives incorporating analyst estimates, price targets, and commentary from earnings call transcripts. These narratives create a fair value estimate around analyst price targets. It's a bit like a reverse engineered price target, which gives you an idea of what those price targets imply for the company's performance. That is another good place to start when you're creating your own narrative and fair value estimate. You can check out these narratives on NVIDIA and many others on the Community tab on the platform. You can filter down to stock-specific narratives at the top. And that just about wraps up this week's Market Insights. To read the key events during the next week, check out the article which will be linked to in the show notes. But that's all for this week. Thank you so much for listening. And until next time, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data.